Hello, thanks for watching. Welcome back to the next video in my series. Now, as usual, a few things before we get started. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. That's way when I upload a new video, you know about it, and it's always nice to connect with my viewers online. If you like the video, please give the thumbs up, share it with classmates or colleagues, or put it on a playlist. That does encourage me to keep making them for you. If you think there's something I can do better, please leave a comment below the video, and I will take those ideas into account when I make new ones. Let's get started.
Business entity forms. There are various ways to structure a business, each with its own legal and financial implications. The choice of business entity form is crucial and can impact factors like liability, taxation, and administrative burden. 1. Sole proprietorship. A sole proprietorship is the simplest form of business ownership, where a single individual owns and operates the business. The owner directly receives all profits but is also personally liable for all business debts and obligations. This means personal assets are at risk if the business incurs debt or faces lawsuits. Example in Cambodian banking sector. A single person opens a small money lending operation in a rural village, using their personal savings as capital. They manage all aspects of the business and are personally liable for any losses or debts incurred. 2. Partnership. A partnership involves two or more individuals who agree to share in the profits or losses of a business. Partnerships can be general or limited. In a general partnership, all partners share in the business's operational management and liability. In a limited partnership, there are general partners who manage the business and have unlimited liability, and limited partners who have limited liability and are typically not involved in day-to-day operations. Example in Cambodian banking sector. Two experienced bankers pool their resources and expertise to establish a microfinance institution. They share the responsibilities of running the institution and are both personally liable for the debts and obligations of the business. 3. Corporation. A corporation is a legal entity that is separate and distinct from its owners, shareholders. Corporations can enter into contracts, own property, and be sued in their own name. Shareholders have limited liability, meaning their personal assets are protected from business debts and obligations. Corporations are subject to more stringent regulatory requirements and may face double taxation on profits at the corporate level and dividends at the shareholder level. Example in Cambodian banking sector. ACLEDA Bank plc is a well-known example of a corporation in Cambodia's banking sector. It is publicly listed, meaning shares of the company are traded on the stock exchange. The shareholders have limited liability and are not involved in the daily operations of the bank. The bank's management team and board of directors are responsible for running the business. Additional notes on business entities in Cambodia. Cambodia also recognizes other forms of business entities, such as limited liability companies, LLCs, representative offices, and branch offices of foreign companies. The specific regulations and requirements for each type of business entity are governed by Cambodian law, including the law on commercial enterprises. It's important to consult with legal and financial professionals to determine the most suitable business entity form for your specific needs and circumstances. ACLEDA Bank plc is indeed a prominent example of a corporation in Cambodia's banking sector. Here's a closer look at its background and significance. Origins and evolution. Humble beginnings. ACLEDA started in 1993 as a national NGO focused on microfinance and supporting small enterprises. This reflects a common pattern in Cambodia, where many financial institutions began by addressing the needs of underserved communities. Transition to commercial bank. ACLEDA obtained a specialized banking license in 2000 and then a full commercial banking license in 2003. This allowed it to expand its services beyond microfinance and cater to a wider range of customers. Public listing. ACLEDA went public in 2021, with its shares listed on the Cambodia Securities Exchange, CSX. This move provided an opportunity for the public to invest in the bank and further solidified its position as a major player in the Cambodian economy. Key features and achievements. Leading financial institution. ACLEDA is one of the largest banks in Cambodia in terms of assets, customer base, and branch network. It plays a vital role in providing financial services to individuals, businesses, and communities across the country. Focus on financial inclusion. Despite its growth, ACLEDA remains committed to its roots in microfinance and financial inclusion. It offers a wide range of products and services tailored to the needs of different customer segments, including those in rural areas and those with limited access to traditional banking services. Digital innovation. ACLEDA has been proactive in adopting digital banking technologies. Its mobile banking app, ACLEDA Mobile, is widely used in Cambodia and allows customers to perform various transactions conveniently. International recognition. ACLEDA has received recognition from international organizations and rating agencies for its financial performance, corporate governance, and social responsibility initiatives. Impact on the Cambodian banking sector. Market leader. ACLEDA's success has helped to shape the Cambodian banking sector, demonstrating the viability of commercial banks with a strong focus on financial inclusion. Competition and innovation. ACLEDA's presence has encouraged competition and innovation within the sector, leading to improved services and greater access to finance for Cambodians. Economic growth. By providing access to credit and other financial services, ACLEDA has contributed to Cambodia's economic growth and development. Challenges and future outlook. Competition. The Cambodian banking sector is becoming increasingly competitive, with the entry of new players and the expansion of existing ones. ACLEDA needs to continue to innovate and adapt to maintain its market position. Economic conditions. Cambodia's economic performance is influenced by global and regional factors. ACLEDA needs to manage risks and ensure its resilience in the face of economic challenges. Technological advancements. The rapid pace of technological change requires ACLEDA to invest in new technologies and upgrade its systems to remain competitive. Overall, ACLEDA Bank plc serves as a prime example of a successful corporation in Cambodia's banking sector. Its journey from an NGO to a publicly listed company highlights the potential for financial institutions to contribute to economic development and social progress. Characteristic of proprietorship. Business entity. Yes, this means that for accounting purposes, the business is treated as a separate entity from the owner. This allows for clear tracking of the business's finances and performance. Legal entity. No, this is a key distinction. The business and the owner are legally considered the same. This has significant implications, particularly for liability. Limited liability. No, because the business isn't a separate legal entity, the owner is personally liable for all the business's debts and obligations. This means creditors can go after the owner's personal assets if the business can't pay its debts. Unlimited life. No, the business is tied to the life of the owner. If the owner dies, retires, or becomes incapacitated, the business typically ceases to exist. Business taxed. No, profits from the business are not taxed separately. Instead, they are considered part of the owner's personal income and are taxed at the individual's income tax rate. This is often referred to as pass-through taxation. One owner allowed. Yes. This is the defining characteristic of a sole proprietorship. It's owned and run by a single person. In essence, a sole proprietorship is the simplest form of business structure. It's easy to set up, but it offers no legal separation between the owner and the business, which means the owner has full control but also full responsibility. Characteristics of a general partnership. Let's break down each point. Business entity. Yes, like a sole proprietorship, a partnership is treated as a separate business entity for accounting purposes. This means the partnership's finances are tracked independently from the personal finances of the partners. Legal entity. No. Again, similar to a sole proprietorship, a general partnership is not considered a separate legal entity. The partners are personally liable for the partnership's debts and obligations. Limited liability. No. This is a crucial point. Because there's no legal separation between the partnership and the partners, creditors can pursue the partner's personal assets if the partnership cannot cover its debts. Unlimited life. No. A general partnership typically dissolves if a partner leaves, dies, or becomes incapacitated. The remaining partners would need to form a new partnership if they wish to continue the business. Business taxed. No. Partnerships follow a pass-through taxation model. The partnership itself doesn't pay income tax. Instead, profits and losses are passed through to the individual partners, who report them on their personal income tax returns. One owner allowed. No. By definition, a partnership requires at least two owners to operate. Key takeaway. General partnerships are relatively easy to form, but they carry the risk of unlimited liability. This means partners are personally responsible for business debts. It's important for partners to have a strong partnership agreement that clearly outlines each partner's responsibilities and contributions. Those are the key characteristics that set corporations apart from sole proprietorships and partnerships. Let's delve into each one. Business entity. Yes, like other business structures, corporations are distinct accounting entities, keeping their financial records separate from those of their owners, shareholders. Legal entity. Yes, this is a defining feature of a corporation. It means the corporation is recognized as a separate legal person with its own rights and responsibilities. It can enter into contracts, own property, sue and be sued, and so on, all under its own name. Limited liability. Yes, this is a major advantage of corporations. Shareholders' liability is limited to the amount they have invested in the company's stock. Their personal assets are protected from business debts and lawsuits. Unlimited life. Yes, a corporation has perpetual existence, meaning it continues to exist even if shareholders die, sell their shares, or the management team changes. This stability is attractive to investors and lenders. Business tax. Yes, corporations are subject to corporate income tax on their profits. This is separate from the taxes shareholders pay on dividends they receive from the corporation. This is sometimes referred to as double taxation. One owner allowed. Yes. While many corporations have numerous shareholders, it's perfectly legal for a single person to own all the shares of a corporation. Key takeaways: corporations provide a strong framework for business growth and investment due to their limited liability, ability to raise capital easily, and perpetual existence. However, they are subject to more complex regulations and tax rules than sole proprietorships and partnerships. Let's break down those concepts and then look at a real-world example from the Cambodia Securities Exchange, CSX. Shareholders and capital stock. Shareholders, or stockholders, these are the individuals or entities that own a corporation. When you buy stock in a company, you become a shareholder and own a small piece of that company. As a shareholder, you have certain rights, like voting on important company matters and potentially receiving dividends, a share of the company's profits. Capital stock. This represents the ownership of the company. When a company has only one type of stock, it's called capital stock. This means all shareholders have the same rights and privileges. Some companies have multiple classes of stock, like Class A and Class B, often with different voting rights or dividend structures. Example from CSX, Phnom Penh Water Supply Authority, PWSA. PWSA is a great example of a company listed on the CSX that issues only one class of stock, which is its capital stock. Ownership. Anyone who buys shares of PWSA stock becomes a shareholder and part owner of the company. Equal rights. All PWSA shareholders have the same rights, regardless of how many shares they own. They have the right to vote at shareholder meetings and receive dividends if the company declares them. Why is this important? Understanding these concepts is crucial for investors. Ownership. Knowing you become a part owner of a company when you buy stock helps you make informed investment decisions. Rights. Understanding your rights as a shareholder empowers you to participate in company decisions and potentially benefit from the company's success. Stock types. While PWSA has only one class of stock, it's important to be aware that some companies have multiple classes with different rights, which can affect your investment. If you're considering investing in the CSX, I encourage you to research the companies you're interested in and understand their stock structure. The CSX website, linked to csx.com.kh, is a good resource for information on listed companies.
Finally, if you like the video, please give it a thumbs up and share it with classmates or colleagues. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. It's always nice to hear from you. If you think there's something I can do better, please leave a comment below the video. So, thank you very much for watching. I wish you the best of luck in your work and studies. I look forward to seeing you again next time.